Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Joseph Boskovich. He is a co-founder and partner at Old West Investment Management. They've got some very interesting positions on. They're like owner-managers. We're going to talk to Joe right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hey Joe, how you doing?
Hey Toby, thanks for having me.
My absolute pleasure. So tell me a little bit about Old West. How did you get started? What's your focus?
Yeah, so kind of the genesis of our process originated in the late 1970s. So I work with my dad. I'm partners with my dad, and my dad in his early 30s, he was invited to sit on the board of a small regional Southern California bank called Santa Clarita National Bank, and so the first several quarters on that board, he noticed the chairman of the bank ferociously buying stock, and decided that he'd buy alongside of him. So he did, and put a significant amount of money into that bank at a young age. And fast forward several years, Santa Clarita National Bank sold the First Pacific Bank, which then sold the Bank of America, and he made a lot of money at an early age. And I think the lesson learned for him at that point was, no matter how much you think you know about a company, no matter how sound your analysis is, you probably don't know as much as the people running that business. And it's funny, in my career, I've seen that time and time again with other managers, investors that I know. One of my colleagues, or a manager of another fund, had a position in the company, thought he knew everything about that company, joined the board, and talked about in one of his letters how once he joined the board, he was so shocked to find out how little he actually knew about that company. So we do our own analysis, put together our own thesis, but at the end of the day, realize that maybe the people running those companies know more than we do. So when you look at our process, fairly simple, but we focus on owner managers, and we don't want to overpay for those businesses. So as a first principle, we want to make sure that all of our investments are run by management teams who have more to gain or lose from their ownership than they do from their compensation. So, I tell people typically the first document that we would look at is the proxy statement, and within the first 30 minutes of reading through a proxy, 90% of the companies just kind of get tossed in the trash can, and we move on. The 10% that pass that proxy test, then we do a deep dive and really try to understand those businesses better. And at the end of the day, a name could come into our kind of focus in a number of ways, but oftentimes we source ideas, first and foremost from SEC Form 4 filings, 13D filings, 13F filings, and simply if we see a CEO, buy $5 million worth of stock in his own company, it doesn't mean we're going to blindly follow him into that investment, but maybe there's something there, and it's up to us to figure out what that owner manager sees in his own business.
So you want an owner manager who has, where you think the company is undervalued as well, and then additionally you're looking for some insider buying on top of that, and that can come through the SEC Form 4 or the 13Ds or Fs.
Yeah, so it doesn't have to be insider buying. That would be how we might screen for a name, but there's a lot of companies that we own where maybe there's not insider buying, but the CEO already owns 20% of the company, right. Or there's an outside investor that we have a high regard for that has a significant stake. So this could be Warren Buffett, John Malone, Bill Sturz. But, if you see someone like that already has a big stake in the company and that hasn't changed, maybe there's something there. So oftentimes we'll try to reverse engineer that idea.
So let's go through your portfolio a little bit.
Yeah.
From the filings that I had a look at, your biggest holding at the moment is a put in Tesla. And so that's an interesting one because we've just been talking about an owner-manager, and Musk is certainly a big owner-manager. So what's the thesis there?
Yeah, so right. Elon Musk is an owner-manager. He owns a lot of stock in the company. Keep in mind when you look at the 13F filings, it shows the notional exposure. So, on the short side, or in terms of protecting the portfolio, we look for situations where we could outlay very little capital, but the payoff is big. So we do own deep out of the money puts, and we roll those over every couple of months. We don't actually currently have that position on right now. But the idea is that we outlay very little capital. I think it's maybe 10 or 20 basis points of capital. And if we are right, that could pay off significantly.
I got you. Right. So the next biggest position is RFL, Raphael. Talk to me a little bit about that position.
Yeah, so it's grown into a big position. I actually just was listening to your podcast with Ian Castle a couple of weeks ago, and both of you make some great points about trimming your winners too early, and so that's at some point I think we would trim back that position, but don't want to do it prematurely. I think there's a lot of potential there, but our investment in Raphael, it's really more of an investment in someone that we think is a great owner manager, and his name is Howard Jonas. And it's funny if you look at the investment landscape. Imagine if you built a portfolio where you identified great owner managers and capital allocators, and you kind of invested alongside them. So think of someone that invested with John Malone 30 years ago and kept all of his spins and really watched him closely. You've done very well. Imagine had you invested alongside Warren Buffett for the last 50, 60 years. You've done very well.
Bill Sturz.
Yeah, Bill Sturz, exactly. So, any of those people profiled in The Outsiders, right? So, Howard Jonas is less known. I think he has a phenomenal track record, and I think that people are going to know more and more about him as time goes on. But so Howard started a company called IDT Corporation in 1990, and IDT, they are in the communications and payment services business, and they've done a great job managing that business. But they've also talked about how the international minutes business has been in decline from free VoIP providers like Skype, which we're using right now, or WhatsApp. So what they've done at IDT is they've effectively managed IDT's cost structure, and they've maximized that cash flow, and they've taken the cash from the legacy business, and they've effectively bought a basket of growth initiatives within IDT. And there's still several growth initiatives still within IDT, but a lot of those they've spun off. So if you look at Howard's track record, and like I said, he started IDT in 1990, but if we just start in January 2010, since January 2010, Howard has spun off 5 different businesses from IDT, and he sold the 6th, after which he paid a special dividend. But he spun off IDW Media, which we talked about all of these. I could talk about each one for an hour if you'd like, but he spun off IDW Media in 2011. I think the next spin was Straight Path Communications, which a lot of people will, that name will resonate with a lot of people.
Well, why don't you tell us the Straight Path Communications story?
Yeah. So, one thing that I've found with Howard is he's a great visionary. In terms of identifying secular growth stories, what's going to be the big thing tomorrow. So the first company I mentioned, IDW Media, he bought that company in the 2000s. It's the fourth largest comic book company in the world, which is misleading because 99% of comic book sales are Marvel and DC. So it's a very small base, but he bought that company. And then he took some of the cash flow that the comic book company was generating and invested in the television production business. And this was in 2009. And anyways, they have 3 shows that will be premiering in Netflix in the next 6 months. But once again, when I talk about a secular growth trend, I think he's identified, streaming and valuable content's going to be in high demand. And I actually listened to your bit recently on Netflix as a short position, and we're short Netflix too. I think the world of streaming, the companies like Netflix are going to get hurt. The companies that are going to do very well are the owners of valuable content like an IDW Media. So anyways, he spun off IDW Media. The second spin was Straight Path Communications. Once again, I think he identified a secular growth trend. So in 2001, Howard basically bought a hodgepodge of spectrum licenses off Windstar Communications out of bankruptcy. And this was in 2001. He paid $50 million. Bought that under the IDT umbrella. And then he, 12 years later, spun off that hodgepodge of spectrum licenses into a company called Straight Path Communications. Well, last year there was a bidding war between AT&T and Verizon ultimately won and paid $3.1 billion for Straight Path Communications, and Howard Jonas owned 20% of the company. So that was obviously a big exit. He had a big $1 billion exit earlier on in his career. So post Straight Path, he spun off Sedge. We are actually the largest shareholder of Sedge. We own 15% of the company. That's an exciting asset. And then most recently, he spun off Raphael Holdings. So Raphael Holdings, it's a holding company. He spun it off from IDT with cash, about $50 million of cash, real estate, which has a book value of $50 million, and that's IDT's headquarters, and then 2 stakes in biopharma assets. So the most exciting would be a 56% interest in a company called Raphael Pharmaceutical. And Raphael Pharmaceutical, they're basically developing therapies for difficult to treat cancers based on the AMD platform, which is altered cell metabolism. So you have chemotherapy, you have immunotherapy. Well, the AMD platform, the medicine is designed to target the mitochondria of just the cancer cells and leaves the healthy cells alone. So you don't have the same side effects that you do with chemotherapy. But anyways, what's interesting, when it was first spun, it had a $100 million market cap, which was basically equal to book value at the time. And you had this option stake in these pharmaceutical companies, which have had tremendous results in phase 1 trials. They now have 2 drugs in phase 3 trials. The one they're most excited about is a phase 3 trial for pancreatic cancer. In phase 1 trials, they treated 15 patients, and 3 of those patients are in complete remission. And this is a cancer where their survival rate's less than 1%. So, it's a little bit of I guess a speculation on the biopharma side, but keep in mind that this was spun, and we're basically getting real estate and cash, and that was equal to the market cap at the time.
Yeah, so you got free options in those 2, basically. Yeah.
Yeah, and then since then the stock's run, so that's not necessarily still the case. But this is Howard Jonas is the chairman of the company. He is largely funding the company, through trials. And when he originally got involved, as you know, with early stage tech and biotech, you might have a great technology, but you fall short of the finish line, and you run out of money. So Howard was kind of that capital injection, and in return, has this 56% majority stake in the company through IDT, and he's all in, and he's spending a great deal of his time on this company, And it's somewhat of a bet on Howard Jonas, but several things have happened over the last 6 months that I also think kind of de-risk the investment. So they just signed a big deal with Ono Pharmaceutical of Japan, where they are going to market that drug in Japan, and they're going to pay Raphael a low double-digit royalty on sales, and they just announced trials in Israel and parts of Europe. So I think as they do that, it also de-risks the investment from an FDA decision in the United States.
Got it. So let's just go back to IDW. You said what are the comic book characters that it has, and what are the shows that are coming up?
Yeah, so this has kind of been a long-term investment for us, and there were some stumbling blocks in the road, but as I mentioned, Howard bought IDW Publishing in the early 2000s. In 2009, it was paying a small dividend. In 2009, he canceled that dividend and invested the cash in taking its IP and turning it into television shows. And they had two shows pretty early on. They had a show called Wynonna Earp, which was based on one of their comic book characters, and that was on Sci-Fi. And then they had Dirk Gently on BBC America. Wynonna Earp is going on season 4. Dirk Gently was canceled after season 2. And there's kind of been this lull where there's been, nothing lately. They have had 3 shows picked up for Netflix. So V-Wars and October Faction will both premiere on Netflix before the end of the year, so in calendar year 2019. And then their best-selling IP ever is a Lock and Key, which was written by Joe Hill, Stephen King's son. And that was picked up by Netflix and will premiere in early 2020. So, what's interesting is, once again, and, one thing that I didn't mention earlier, so we look for companies run by owner-managers. We want to buy into that asset at what we think is a reasonable price. But then third, I think if you could identify a company where there's a breakout business, I think that's very interesting because, as we know, if you're a value investor, you could buy things that are cheap, but usually things are cheap for a reason, and that's because no one wants to own them.
Right.
So if you could identify some sort of catalyst, and that that could be a hard catalyst or a soft catalyst, but if you could find a business where there's this breakout business where revenue is going to grow significantly, maybe that could be the catalyst. So in IDW Media's case right now, if you looked at the income statement, all of the revenue is generated by the publishing business. So entertainment was generating revenue before Dirk Gently got canceled, and there was kind of an interruption with Wynonna Earp. But the company has already said that V-Wars and October Faction, those 2 shows, will contribute $27 million in new revenue to the entertainment division in the fourth quarter, or in the end of the year here. And then Lock and Key is done on a producer fee, so it'll be $2.5 million licensing fee from Netflix in revenue, but that'll go directly to the bottom line. And then Wynonna Earp is about $8 million in revenue. So here you have a company that, if you look last quarter or the last calendar year at the income statement, the entertainment division is doing 0, and the entertainment division is going to be doing 35 to 40 million the next 12 months. So, once again, this is a business where everybody's focused on the publishing asset, but there's this entertainment asset that's going to have significant income state contribution.
How material is that
future.
to IDW?
Yeah, it'll double its revenue.
Right. Wow.
Yeah. So that's interesting. And once again, I think that you need to underwrite every investment separately. But IDW Media, Sedge, Raphael, IDT. I don't know that we would be invested in any of these businesses if it weren't for Howard Jonas and we've taken a lot of time in studying him, reading about him, meeting him, spending time with the management teams at the different companies to feel very comfortable. But once again, I mentioned all these spinoffs. So had you invested in IDT Corporation in January of 2010, through today, if you were invested in IDT plus all the SpinCos, your compounded return is about 50% per year. Wow. versus 10% for the S&P 500. So, I think the results speak for themselves. And if you look at what he's done and his successes, it would suggest that a closer look at his actions is warranted.
Well, who is he? What's his? I've never heard of the name before. Where does he come from?
Well, it's funny, and most people haven't. And but like I said, he didn't just emerge recently. He started IDT in 1990, and he's built a great business. And I really what he did is think of the international callback. He basically pioneered that business, and then he's constantly the company's morphed to keep up with the times. And then you think back calling cards. Remember when you would use calling cards? IDT kind of pioneered that,
like the prepaid card.
Yeah, they pioneered that business, and he's continuing. In the early 2000s, he talked about how he felt the telecom business had become too commoditized. So he bought a small children's programming studio and basically built a company called IDW Entertainment. And he built IDW Entertainment over a series of years. And in 2005, he sold IDW Entertainment to John Malone and Liberty Media for $500 million. And that was kind of his first, one of his first big successes. And then he took that cash from selling that business to John Malone and, invested in a lot of these other growth initiatives.
Right. So I think the one spin that we didn't discuss was Sedge.
Yeah. So Sedge is really interesting. So Sedge, I feel like, well, obviously Raphael, I feel like the risk is muted and the potential return is infinite. And Sedge is similar. Sedge is the smallest company. It has a $15 million market cap right now. And he bought Sedge so when he sold IDW Entertainment to John Malone, he used the cash from that sell and he bought two assets. He bought IDW Publishing and he bought Sedge. And both are kind of in the content space. And Sedge, was founded as a wallpaper and ringtone app, which, sounds kind of silly. And we thought it sounded kind of silly too. So we received our shares from the spin, but we never really bought more into it. And there was an acquisition 2 years ago that really changed the way I view Sedge. So this was just in the fourth quarter of 2017. Sedge bought a company called Freeform Development, and they retained its founder, a gentleman by the name of Tim Quirk. And I was kind of fascinated by that, right? What's Freeform Development? Who is Tim Quirk? So I kind of dug in a little bit more, and I actually found a great podcast with Tim Quirk, and that really changed the way I thought about Sedge. And what I realized, so wallpapers and ringtones, as silly as that may seem, Sedge has 35 million monthly active users, which is a huge number, right? I mean, find an independent app that's not already owned by Google or Facebook that has that sort of user base. So really,
what's the product? What's the product look like? Because I do remember ringtones and wallpapers being huge business. And I saw I saw it on Twitter, somebody tweeted out a stat saying something like, and I'm going to get the timing wrong, but it could be 10 or 15 years ago, that was like a $5 billion a year business. That just because of the way that phones have developed, it's no longer as big as that. So what are these guys? What's the consumer getting when they buy these things?
Yeah, well, so they still have 35 million monthly active users. So people are still interested in that core product, but then I think you need to take monthly active users to daily active users to hourly active users. So what makes Instagram or Facebook or Snapchat, what makes them so popular? It's not that they have a big monthly active user base, but these users, they're using it daily, they're using it hourly, they're using by the minute. So how do you increase user engagement? But so when they bought Freeform Development, I kind of sat there and I'll talk about Freeform in a second, but it's not about the wallpapers and ringtones. It's about the 35 million monthly active users and how do you monetize that user base. So at the time, Sedge, they were doing about $12 million a year in revenue, and it was all advertising from the big advertising exchanges, right? So you download a wallpaper and then you have to watch a 30-second commercial. So that was 100% of the revenue. So how do we monetize beyond that? So I watched this podcast with Tim Quirk, who founded Freeform Entertainment, and he has a really interesting background. He was a musician growing up. And then he was one of the early employees at MySpace and did very well there. And then he was hired by Google, to help. He was one of the first employees hired at Google to kind of build the Android store.
Right.
And when he was hired by Android, his title was, sorry about that. When he was hired by Android, his title was he was the head of all digital content programming, and keep in mind his background's music. So what he was baffled by at Android was here we live in this world where in the digital age, movies, books, music have all just gotten absolutely pummeled, right? If you look at music sales, they're down in the dump. You look at book sales, down in the dump. Movie sales down in the dump because this new digital age, piracy, whatever, it's changed everything. But the one content category that had been killing it was mobile gaming. And really what mobile gaming had figured out was this whole freemium model. So in his interview, the company he uses is he talks about Kings, which makes the mobile game Candy Crush. And he talks about how with Candy Crush, originally it was a paid app and nobody was downloading the app. So then they make it a free app and they have all these in-app purchases. And by having these in-app purchases, all of a sudden, all these people are downloading the game. So there's 300 million monthly active users that Candy Crush had built up to. They had 300 million monthly active users, and most people get the game for free, never pay, but the people that do pay are the hardcore fans. So there's only a 3% conversion rate, but out of that 3% conversion rate, Candy Crush was making $1 billion a year.
Wow.
So Freeform basically took the lessons that he had learned at Android and applied it to music. So he was doing this with artists now. So he was taking artists and, artists, instead of giving their content away for free on, iTunes, now there's all these metrics where you could unlock music and take different conversion metrics, and so the fan's not paying for the music, but you watch a commercial or you take some other action that generates more money for the artist than they would make if the album was free on iTunes in the first place. So that kind of really resonated for me. So when Sedge bought Freeform, then they were, take what Freeform was doing with music and extend that to all content. So artists. So right now, if you go on Sedge app, they launched it's Sedge Premium. So, they basically now have, it's a marketplace, and they have about 1,000 different content creators on that marketplace right now, from artists to musicians. And it's basically providing a platform where artists can monetize their creation. They can monetize their content that otherwise they weren't getting paid for. So you take a dedicated artist who has a day job, and now they have their content up on Sedge and they're making $100 a month, let's say. And although that they can't retire, that's significant income to help them do what they love.
Got it.
Yeah.
So this is an odd segue, but this is the way that the portfolio looks. So I have to kind of ask this question. The next biggest holding after RFL is gold.
Gold, yeah. So I think gold. You mentioned the other day in the interview I watched when you were talking about Netflix that you think this is a great environment to short. And it's funny. Let me take you through our kind of the genesis of our company. So we started in 2008. Our first 5 years, our performance was great. I think we were probably top decile. We were raising money because of our performance. We grew from 15 million in assets to 200 million in assets, and the last 5 years has been exhausting. You kind of feel like you're running in place. You've seen all the the comparisons. Basically, if you haven't owned the FANG stocks and some of the momentum stocks, it's been very difficult to outperform the market. And I think where my philosophy, my process has evolved a little bit is I used to always think bottom up instead of top down. And part of the problem with that is take the reverse of our buy process. Likewise, if we see companies with massive insider selling and extreme overvaluations, maybe those are candidates for the short book. Well, in this world we've lived in, where you have central bank manipulation and money printing and zero interest rates, and basically that's made it impossible to short. So I think really what gold is it's an investment in monetary.
Short monetary recklessness.
Yeah, we're short monetary recklessness. But once again, I think you enter the bottom up part of our process, and we don't own the commodity. We own miners, and then you look for the miners that are run by the best management team. So I think our biggest gold position right now is Barrick Gold, and you look at Mark Bristow, who was acquired from Rand Gold, and I think they're the best in the business. So once again, try to align ourselves with the right management teams. But yeah, so we do have a good gold weighting, and we look pretty silly.
What's working now?
For a while, but it's working now. Yeah,
it should be looking good now. And then the next holding in there, and this is a longer discussion, but you've got some exposure to uranium as well.
Yeah.
There's a very long thesis there. So just give us the short one, and then we'll move on to the uranium opportunity.
Yeah, so it's an incredible opportunity. We actually don't feel that we've ever seen an opportunity like this. So we actually launched a fund dedicated just to the uranium mining space about a year ago. But just like any commodity, it's a supply demand imbalance. And what created the imbalance? If you go back to 2011, you remember the Fukushima earthquake and tidal wave off the coast of Japan, and that tidal wave damaged one of the nuclear reactors. And as a precaution, Japan shut down their entire nuclear reactor fleet. And at the time, I want to say Japan accounted for about 20% of world demand. So imagine that you have 20% of world demand going away overnight. As a result, the price of uranium fell from $70 a pound to $18 a pound, and it's basically been this a depression ever since. And when Japan took the nuclear fleet off the market, you had this we were awash in supply. And it's taken a long time to work through that supply. A lot of people have been involved in this space, since then, and they've been wrong. And I don't think they're wrong. They've just been really early. But being early and wrong is the same thing in this business. And so there's been a number of things that have happened in the last 12 or 18 months where we feel that the situation is going to reverse in the near term.
So what causes the cycle to shift?
Yeah, so like I said, it's supply and demand. So right now, worldwide, demand for uranium is about 200 million pounds, and primary supply, I think, is about 130 million pounds. So the difference would be the spot market, and so what you've had is you've had all this oversupply, you've had all this stockpiled uranium, And in the last 18 months, so this is interesting. So go back to 2011. This was a $150 billion industry, and there were, many players in this industry. Well, today the entire industry is about 7 billion. So 7 billion market cap, and 80% of that is two producers. It's Kazakhstan, Kazatomprom in Kazakhstan, and Cameco, which is a Canadian-based mining company. And like I said, they represent 80% of the supply. So in the last 18 months, Cameco, they put their largest mine, MacArthur Lake, on care and maintenance. So that cut their supply by about 20%. And Kazakhstan did the same. They cut their supply 20%. They just committed to cutting it 20% through next year. So you've had 20% of supply come off the market in the last 18 months, and that's basically, imagine that's the equivalent of OPEC saying, hey, we're going to zero. Imagine what would happen to the price of oil had that happen. So you've had all this supply has come off the market, and Cameco, they've said rather than produce uranium, or rather than produce new supply at prices where we're not making money, we're just going to buy off the spot market to deliver into our long-term contracts. So just last quarter, they announced that they were going to buy 1 million pounds off the spot market. Well, they bought about 200,000 pounds, and spot moved like to 28. So, there's two prices to look at in the uranium market. You have spot, which is very illiquid, and then you have the long-term contracting prices, and long-term contracting prices, that would be the price where deals are struck between the utilities and miners. And in the end, spot will trend along long-term contracting. The problem is you've had no long-term contracting for years. So long-term contracting, you're looking at 5, 6, 7-year contracts. And like I said, there's been no new contracting. And part of the reason is because of Section 232, which was just decided by President Trump. But basically, 18 months ago, the two U.S. producers, Energy Fuels and Your Energy, they petitioned Section 232 with the Department of Commerce to basically look into the role that uranium imports play in our country's national security. So we are the largest consumer of uranium here in the United States. 98% of our uranium is imported, half of which is imported from the sphere of Russia. So, President Trump, so the U.S. producers, basically what they asked for is they asked for a quota where the utilities would have to buy 25% of the uranium needs from U.S. producers. And, President Trump basically came forward and he said, well, we're not going to do that, but we're going to put together a 90-day working group to really help the entire nuclear fuel cycle in the United States. So, I think basically what President Trump did is he came forward and he said, hey, look, we're going to help you guys, just not at the expense of the utilities. So in the next, that was 90 days, time's passed. So, pretty soon I think you're going to see some sort of measure taken to, assist, like I said, assist the entire nuclear fuel cycle in the United States.
But it's not going to be a subsidy or a tariff. It could be something like that. Okay, I see.
No, it could be, and I actually wouldn't be surprised to see some sort of action taken where the U.S. producers are given a fair playing field as it relates to all the international. Because it's not a huge difference, but the price that utilities would have to pay a U.S. producer are a little higher than what they would have to pay a producer in another country where maybe the fuel standards aren't as high. But so anyways, as I said, and we've seen this when Cameco went into the spot market to go buy uranium, the spot price moved up pretty quickly, and so essentially there's not enough stockpiled, there's not enough on the spot market. We are going to need new supply to fill that deficit, and the cost of production is about $40-50 a pound. So you're not going to see any new long-term contracts entered into between the utilities and the the miners, unless that price is going to be material higher. And as those contracts are struck, you're going to see spot rise. And I think it's going to happen pretty dramatically. And a lot of these companies, keep in mind, if you're a development company and you have this development, but it doesn't make any sense to develop your project unless uranium prices are at $50. You have a lot of these companies that are trading at options. They're trading as options, yet the NPV of that project is 5x, 6x, 7x. So Energy Fuels, which is the largest U.S. producer, I think the stock's it's a $2 stock right now. Well, at the last peak of the uranium market, it was a $250 stock.
Right.
So
how do you think about playing that opportunity? Are you looking at producers, or are you looking at the nuclear energy? Forgetting the name of that. The developers, the explorers.
Yeah.
How do you play it?
Right. So you have the producers, and like I said, keep in mind what I said. 80% of production is two companies. So you have Cameco, you have Energy Fuels is produced in the United States, so there aren't many, and then you have developers, and then further down the tail you have explorers. So really, the position. So in our kind of main funds or the funds that we've been managing for the last 10 years, most of the exposure is in the bigger, producing names. But in our new uranium fund, we basically have taken a basket approach to owning the producers, the developers, the explorers, and maybe some companies won't do well, but others will. And we think that basket approach is probably the smartest way to play the space overall.
That sounds very interesting. So we're coming up on time here, Joe. So if folks want to get in contact with you, what's the best way of going about doing that?
Sure. You go to our website, Old West IM as in investmentmanagement.com, and our contact info is there. If you go to the press section of our website, we have all of our quarterly letters and manager interviews posted. And I've always said that at the end of the day, we are concentrated investors. We're all about the names, that we own. And so, if you read all of our quarterly letters, you've basically read 75% of our portfolio.
Got it. Love it.
Yeah.
Joseph Boskovich, Old West Investment Management. Thank you very much.
Great. Thanks a lot, Toby.